Hello everyone, welcome back. Today our presentation is about Saia LTL. It is an American transportation company which main business is in the less than truckload industry. In this presentation we're going to talk about the truckload and less than truckload market in general and analyze some industrial data. And then we're going to talk about Saia, what makes it special and what are the strengths or potential weaknesses. So let's begin. First, I would like to state my thesis. I think Saia LTL Freight is a solid defensive stock with strong track record of consistent growth and goal execution by the management. It is relatively shielded from recession risks, but can fully capture the upside of the expansion cycle. It has a long-term oriented business model and is recovering stronger than ever from the recession. That is my thesis on Saia. So before we go into detail about Saia, this company, I would like to introduce the transportation industry in general, and more specifically about the trucking and less than truckload industry that Saia operates in, to help investors have a more broad or comprehensive picture about what kind of industry environment that Saia operates in. And that is very important later on as we make some strategic decisions about Saia. So first, I would like to mention that transportation has always been the pillar of U.S. economy. From the railroad, everyone knows the railroads are a growth stock and they're huge at the time of American westward expansion. To automobile, Ford, to trucking after the evolution of automobile and the national highway system, etc. To airplane, right, to Delta and all the American airplane companies, Boeing, for example, and most recently LTL. I think LTL is a more recent evolution or mode of transport for freights, because it really needs big data analysis and a lot of organizing and AI technology to make it work. So really LTL has evolved in the recent decades, so it's a relatively new mode of transportation for freight. Of course, I think transportation has always been a pillar for the U.S. economy and facilitating the exchange between the West and the East. If you think about how American economy has grown over the last 2 centuries, we can see a clear pattern of continued westward expansion, bring back all the raw materials or products, and then to the East, and then East manufactures it and then sell it back to the West. So there's this kind of national economy goods exchange going on all over America. And the transportation industry, more specifically trucking, has facilitated this mode of exchange and largely contributed to U.S. economy growth. So it's a really important industry that will remain relevant in the foreseeable decade, I would say. More data on trucking specifically. Truck moves 72.2% freight in all America and accounts for 67% of cross-border trade between US and Canada, and more specifically 83% from US to Mexico, because everyone knows there's a lot of manufacturer spots in Mexico, and it relies heavily on trucking to transport the goods to America. So it's really like a lifeline for U.S. economy, and it facilitates all the cross-border trades with other countries. And according to Saia, there's 1 million miles of line haul per day for just this company. So you can imagine how big their scale is, like what kind of business they're operating in. And also, I would like to mention on the picture on the right, there's this cycle and there's this continuous trend line. And I believe the transportation industry is a good example of this picture. There's always up and downs of the economy, but the trend line is always going up. It's always growing as the U.S. economy is growing and the shipping volume is growing. So that is one of my theses about the transportation industry. So let's have an overview on the truckload market, which in abbreviation is TL. I would like to mention that I do not recommend investors to invest in the truckload market for 3 reasons. First, it is very fragmented. 97.7% of all truckload companies operate less than 20 trucks, so there are no benefit of scale, because for LTL companies they operate thousands or tens of thousands of trucks. So for 20 trucks, it's really a relatively small scale. And most of them are like single owner operators, so they own a truck and they're the driver, the business owner is a driver, and they can get a license, and that's all they need to enter the truckload market. So there's very low barrier of entry. And third reason is it's very cyclical, and it depends on the spot market, which is a market for freight. And as we can see in the right picture, there are 3 cycles of the US truckload market. The first one is the seasonal demand, for example, the Christmas trees and the summer barbecues example. And annual procurement is for contract, because most long-term contract renewal are set in the first couple months of the year. So that contract reset can last for a whole year, so that's very important. And that contract, it depends on the spot market performance of the last year and foreseeable year. So it's very cyclical, I would say. And the third one is market capacity, as we'll explain in the next slide. It's always very volatile, and every up and downs involves a lot of drivers going out of business and flooding into the industry again. So this very cyclical I don't think is beneficial to a long-term investor, or those who does not want to just face a lot of risk or potential downsides if the cycle turns against their favor. Here's a graph that I copied from the Coyote Freight website. So it shows how volatile the truckload cycle is. You can really see from 2007 to 2023, which is right now we're in. The blue line is the contract, and you can see it fluctuates from 0 to 10%, around 10%. But I would like to mention that even if it is not a lot, 10%, it is still very significant, because many truckload companies, their profit margin is slim. Like their profit margin is 10%. So if it goes down by 10%, that means they're losing money, right? And then the green line is the spot market, and we can see it's very volatile. Every up and downs involves a lot of bankruptcies. All the truckers have to be cleared out. Some of the truckers, the excess capacity has to be cleared out for the cycle to recover again. But we do see a pattern that it always recovers no matter how bad the outlook is. So right now we're in 2023 first quarter, and the outlook was pretty negative. Some people say it is the most negative outlook they've ever seen in their decade-long trucking career, because the 2020-2021 upcycle was so huge and profitable that everyone joined the trucking industry basically. So they're expecting the downturn to be pretty bad. But right now we're seeing is that it's not that bad, and we're expecting a soft landing here. And the data, the decline of the shipping volume has really decelerated. So we're seeing the trucking industry starting to recover, and potentially going upwards in the second quarter or the third quarter of 2023. So that's a very positive sign for the trucking industry and LTL industry in general. Alright, let's go in more detail about the less than truckload market. Before we begin, I would like to mention that the less than truckload market is the exact opposite of the truckload market that we mentioned before. And I think people should not just overlook the potential of LTL or trucking in general, just because their impressions on the trucking is they're fragmented, they're not generating alpha value, anything. That's true, but there are other modes of business within the trucking industry that are completely different, and people should not overlook the fact. So yeah, I hope this video really helps investors to learn more about the LTL industry and more about trucking in general. So LTL industry is the exact opposite of the truckload industry for 3 reasons. First, it has a very concentrated market share. According to my data, top 10 companies control 77% of market share. That is a very consolidated market, and we're seeing the consolidation continuing. We're seeing some bigger names acquiring the lower names on the scale. So this is a continuing trend, and we're expecting that number to keep rising to the 80 or 85 in the near future. Second, there's a high barrier of entry to the LTL industry. So I do not think any company or just trucking company in general can enter the LTL industry and then become a dominant player in the next 3 to 5 years. I don't think that is possible without heavy capital expenditure on establishing a national logistics network, and they have to have a lot of experience, customer connections, etc. to make that work. And when they first enter, I don't think they can make any profits off that, because it really depends on their efficiency, because it is really a pretty tight market, and pretty much the premium customers are all taken by existing players, so there are not much new expanding customers. Third is it has a strong pricing power due to price disciplines among the top players who control the market, and this helps them to remain positive spread, which is the cost and the price structure over, I think, 13 years for Old Dominion Freight Line. So it is a very, I would say, great fact for the companies within this space, because they can always shift the cost from them to customers, and the customers are relatively, I think, accepted to the price increases for a couple of reasons. First, they have a pretty fragmented customer base, and no single largest customer accounts for more than 3% of their total revenue. And second, the AUM on their package is pretty low. It's about $300 to $400. So I think a 5 to 10% increase would not make a huge difference if they really want their package delivered on time and not hurt by the rough handling, etc. So customers are more focused on the service instead of price. So that is one primary reason how the price disciplines or the strong pricing power of the consolidated companies can remain in place after decades of price increases. So just to introduce LTL industry in general, here is the data I grabbed online. It says from 2022 to 2027, the industry will grow at 7% annually, compounded. That means it is faster than the growth of U.S. economy, and it will likely exceed the inflation. So, contrary to most opinions, LTL industry is actually growing at a pretty good speed. So it is not in a position that is stagnant. It is still growing with the U.S. economy. And from the right picture I grabbed from the Saia investor presentation slide, we can see, we can visualize the top 10 LTL carriers and their relative market share. So Saia is on the bottom of the scale here, but I would like to mention that the last, I would say, like 6 to 7 players their market share is relatively the same. So I would not think that makes a very big difference to investors. But anyways, we can just see that the top 5 companies, according to Saia, controls 55% of the LTL market. So that is a very significant number. Like we mentioned before, LTL industry has a very high barrier of entry, partly because it needs all the players to have a national logistics network that includes many real estates and trucks and customer relationships. So LTL means less than truckload, so the package is not big enough to be rented as a full truck, so it needs to be shared with other shippers to like combine all their packages into one truck and then ship it to their destinations. So the first step is the pickup. So LTL truck will pick up multiple orders from its region and bring it to their center. And the second step is sort the package and then put them on different trucks or line hauls or long distance trucks that are heading to different directions, and then they'll transfer to the next hub, offload some part of their goods, and then load on more goods heading to the same direction. After this comprehensive network, they arrive at the final destination or delivery center, distribution center, to be distributed by trucks to the final destination or their customer. So really, it is a very complex system of logistics, and to guarantee a low claims ratio, a low loss ratio, and then on-time service, it needs a lot of work between the process, and there's a lot of space to improve. So yeah, so I think this industry is definitely superior than that of the truckload, because truckload is relatively easy. You just people rent your truck, rent your service to deliver a service from point A to point B. That is very simple, and everyone can do that. But for LTL, that is very different and it's quite complex. So it has a very high barrier of entry. The third point of why we should invest in the LTL industry is it has strong pricing power, and we can see how big of a role pricing power is within the LTL industry. So, for example, in the 2022 October and November month, the shipment was down, and the weight per shipment and tonnage was down too. You can see on the chart it's relatively 7 to 8% for shipment volume, and then 8 to 9% for tonnage. So we can see that because there's a recession, and then their customers are producing less products, they're shipping less often, so that is a negative for the trucking industry in general, because less of their service was required. But we can see the revenue was up for example, Old Dominion is up 7 to 9%. So that is very odd for some investors, because your volume was down. How can you increase your revenue? So that comes to pricing. So according to Bloomberg, it takes 3% in tonnage growth to offset 1% in yield decline, and vice versa, 1% in yield increase will offset 3% in tonnage or shipment decline. So last year, Old Dominion increased their GRI by 4.9%. So that really largely covers the recession or cost inflation related expense, and really pass it to the customers, and they're able to continually increase their margin or their spread over the coming years. So that is a very strong pricing power, and this ability is not seen in a lot of industries. So I think that makes up for a large thesis for why invest in the LTL industry is very important. Here are more details about the pricing power and the rate increase. It's called the general rate increase, GRI for abbreviation. For most of the companies operating the LTL industry, their GRI is between 5 to 8%, around this area. So for Saia, the company that we're presenting today, it has really outperformed its relative peers in GRI data. So it has increased more than their peers. So that is a very positive sign, which means they are trying to make up for to capture more margin or lost profits, because their service was above the average, and their pricing has some discrepancies. Their pricing is pretty low, so they're trying to capture more of that lost profit and charge for what they deserve. So I think that is a very positive sign, and for Saia to achieve above average growth in the upcoming future. Another fact I would like to mention about the pricing power and how that relates to the firm's profitability is to introduce an important ratio, which is the operating ratio for trucking companies. For most trucking companies, 94% OR is considered okay, like industry average, because that's the expected profit margin for a trucking company is around like 3 to 5%. But for Saia, it has achieved 84%, I believe, for the latest data OR ratio. So that is pretty good, considered above average in their LTL space. And for the best is ODFL, Old Dominion Freight Line, and I think the lowest OR is 74 to 73%, I believe, and that is really significant because you rarely see transportation companies achieve this kind of returns on their like operating activities. So it has a lot of efforts in cost management and pricing power, and that is quite significant. And it's part of the reason why I think LTL industry is more attractive than the TL industry, because there's more potential margin increase. And we can see margin increase largely contributed to their earning per share increase of 46% over the last 5 years, and it's annual CAGR, right? So their revenue is relatively 15%. It's pretty good, but their income or their earning per share has far outpaced their revenue growth, mainly because their cost control measures. So they're getting more money on the same revenue, on the same order they receive. So this is another graph on the LTL and TL industry, and we can compare their financial metrics with each other, and we can really see that the LTL industry has superior financial performance than the TL industry, partly because the reasons we mentioned before. So just to put that in insight of Old Dominion Freight Line's OR ratio, its operating ratio is about like 73.5% in the 2021, but compared that to the railroad industry, we can see the average is about like 60 to 65%. So really, there's still like 8% gap, but I would just like to mention that for a LTL, for a trucking company to be achieving or to be close to achieving the same OR as railroad, who have like a regional monopoly and their years and decades of consolidation, so it's really significant. And I think many value investors like Warren Buffett himself have invested in the railroad stocks in the early days, like BNSF, for example. So if Warren Buffett sees this trend of LTL industry, their drop in OR and how fast they're improving their efficiency, he really like to invest in this space, I believe. So just to put that in context. So for the next part of our presentation, we're going to focus on how does Old Dominion Freight Line and Saia focus on improving their operating efficiency and reducing cost by looking at where they're spending their money, capital expenditure. So as we can see, the first part, the orange part, is tractors and trailers. So they're buying new tractors, and the green part is real estate. So they're spending money on, for example, the service centers, the warehouse, truck maintenance centers, etc. And the gray one is the IT systems, and we'll talk about that and how that improves the operating efficiency in the upcoming slides. So first, let's talk about the new tractors. So I think as tractors are becoming more and more energy efficient and safe, their insurance rate are going down and their fuel costs are going down. So that is a positive for the trucking companies who use this equipment to make profits. And there's a new trend of Tesla semis, coming to deliveries in the upcoming 2 to 3 years, I believe. So that will be a pretty big change for the trucking industry in general, because I think EVs are really like a revolution to the traditional transportation, combustion engine transportation, because for especially for like long-term transportation, like the majority of their costs are on fuel. So if they can spend less money on fuel and produce less pollution, that is really net positive for both the company themselves and the environment. So I would like to see more upcoming changes on the electric vehicle revolution. The second part is the Congress proposed infrastructure bill. So we can see that Congress is planning to spend a lot of money on infrastructure to improve Americans' infrastructure. So, for example, the roads and the bridges, and these are going to cut the average distance traveled by trucks to deliver a package by a lot, and this will reduce the wear and tear of their trucks. So I think the American government spending on infrastructure and utilities are positive for the trucking companies operating on these roads. The second major expenditure that we can focus on is the service center expansion, and we can see how there's a trend of LTL companies growing from regional to national or transnational operating companies, and their local market share has really expanded by a lot since by the recent decade. For example, for ODFL, their West market, for example, 7.3% for 2010, and then in 2020 it's 11.3%. So that's close to more than like 50 to 60% increase over the past decade. So I think that's pretty significant, and I think there's plenty of space for them to grow beyond that, because really 11.3% is just the beginning. It can control probably like 16 to 20% in the next decade, as we can see more service centers are being built across the country. And for Saia too, they have a pipeline of potential projects, and right now they're focusing on building, I think their goal was to expand 5 to 6 service centers by this year. So really this is a very fast-paced expansion, and that saves them a lot of money, I think. We're going to talk about it in the upcoming slides. But really, service center expansion is a long-term strategy, and they're not going to be impacted by the short-term economic swings up and downs. They may be slow, but they will not be stopped, because trucking companies are really focusing on improving their long-term market share, their long-term service speed, and potential price increase for the improved service. And service center expansion is important, where essential part of that plan. So they're continuing on executing their strategy no matter how bad the potential economic outlook is, and they're sure that these will return great profits once the upsize comes and they can fully utilize their potential capacity. So this is a chart I found online about how service centers can improve the delivery speed. As we can see, for 2 trucks to pick up the same package, they require less time than for 1 truck to do the same job, because there are fewer like back and turns and larger efficiencies. For example, Saia has built North Terminal and the South Terminal in Atlanta metropolitan area. So that really improved. They can see a significant improvement in the delivery time and their local market share, partly because they have 2 terminals serving 2 different markets now, instead of just 1 terminal serving the whole area. So that allows them to be more efficient and potentially generate greater returns on their investment. And the last part, but not least, that I want to mention is the technology in LTL. Contrary to what most people believe, LTL is actually very technological intensive, partly because it has a very complex logistical network to operate on, and then their pricing is quite complex. So to find the right price for the right customer is quite difficult and requires a lot of like big data collection and AI. Technologies like that can really help LTL companies to further improve their pricing structure and deliver more packages on time. For example, some of the LTL shipments go into limited access points, which are residential, and usually these involves accessorial charges because drivers have to assist to unload and like transport the goods between the trucks to the residents. So before, without for example, the geolocation, the geofencing, and big data, Saya cannot really locate their customers and charge them for what they actually owes. But after the big data was introduced, Saya was able to correctly price and charge the customers, and they was able to realize more accessorial charges related profits. So that's one of the examples of how technology can help LTL companies improve their operating efficiency and improve their profit margin. So I would like to mention too that remember what we said before, Saya operates 1 million miles of deliveries one day. So that accumulates to millions, hundreds of millions of miles per year. So if any operating efficiency can be achieved using big data, for example, in the dispatch or the logistics transportation, like how to find the best route or how to avoid traffic, for example, these incremental efficiency achievements can account for a large percent of the potential increase in efficiency, and that's very significant. So I would like to see more technology spendings in the LTL space and how that can revolutionize the industry in a way we never seen before. So what we mentioned before, all the three major capital expenditures and how that improves the LTL cost structure, I think that is the baseline for LTL companies, and these can guarantee stable company growth in the near future. But what investor wants to see is more than that, is big upsides, big growth potential, and that's what makes LTL companies really attractive compared to other transportation stocks. And right now we're going to talk about what are its upside potentials for LTL companies. As we can see from this graph, LTL stocks outperform S&P by a large margin. As we can see during the peak of 2021, the rise was actually 350% increase or in stock price. So that hugely outperforms the S&P, which during that same period returns is about like 50 to 60%. So what makes people wonder is how were LTL companies able to achieve that kind of significant returns equivalent to that of the tech companies, some of them. So yeah, so that is the question that we're exploring now. Here are three factors that I think contributed to the outperformance of LTL industries compared to the S&P index in general. The first one is the outperformance related to network capacity utilization. So right now, many companies are having excess capacity issues, and they're maybe keeping like 30 to 40% excess capacity. Many investors wonder why are they keeping that? Because when their economy starts to recover, it's a relatively fast process, and they don't have enough time to build enough service centers or hire enough drivers all of a sudden to service all that demand. So they knew the economy is going to recover in the near future. So right now they rather just take the pain and then keep all the drivers hired, so they can they can be like fully exposed or fully capture the upside potential once that recovery finally comes. And the capacity utilization when the upside is really exceeds 100%, I think sometimes, because during that time, like the COVID years, a lot of freight are chasing after the drivers. They want them to deliver the freight at no matter what cost they are, probably because transportation costs are such a low percentage compared to the overall profits they can make if they got that raw material or goods delivered to their customer. So they're paying insane amounts of money for drivers to deliver their goods, and all the LTL companies are operating at their max capacity to service all that demand, and they still can't service all that demand. So that results in a very high ROA and market share expansion once that upside comes. And if you have excess capacity, then you can really expand your markets and get new customers. So that's an advantage. And second one is the fuel surcharge revenue, because a lot of people doesn't know. They thought since fuel was uncontrollable factor in the LTL or transportation space, and they can't really and it's like the second or first biggest cost. If the fuel price goes up, they can't control it, then they should be like cyclical, right? But it's the opposite in the LTL industry, because they actually pass the fuel increase charges to the customers. They have a fuel surcharge program, and the revenue on that program is actually like more than 50 to 60%. So that means they're overcharging their customers for the fuel, and it's like a dirty secret within the LTL industry, basically. But I think the customers just take it as a given, because they really don't have any other choice to help LTL companies overcome the fuel discrepancies, I would say. So when the economy is prosperous, the fuel price is likely going up, so they have more fuel surcharge revenue. So that's a huge plus to their company earnings. And the third factor is the price per mix. As we mentioned in the first point, when the economy is going up, a lot of freight are chasing the driver, so the prices can literally like skyrocket 40 to 30% in a short time. So they have higher prices and more profitable loads. They're able to choose the heaviest, the longest, and the most easiest for their network to transport. So they really have a lot more options and charge a lot higher prices compared to their relative peers. So that's how they're able to really capture the full upsides of the transportation cycle. And in downturns, as we mentioned above, they're able to use price disciplines and price increase to really not be as impacted or as heavily influenced by the recession as some of their competitors, like in TL space. So now we're going into the company, like Saia in general. So why choose OD or Saia within the LTL space? So here I present a graph, and I think that should make this question relatively easy to understand, because as we can see over the 10 years, service center growth, those who were able to really achieve meaningful growth is Saia and ODFL. Achieve 13% service center growth, and all the other companies, either they're feeling stagnant or they're like decreasing. So that's not a good sign for transportation companies. For shipment, we can also see that some of the companies, their shipment decreased by like 20-25%. So that is not a good sign. But for Saia and ODFL, their increase is quite extraordinary. So that's a very positive sign. And one of the investment strategies that people within the transportation industry should have when it comes to LTL stocks is invest in the cycles. All right, when there's up times, their PE can go as far as 45%, 45. So that's quite high valuation for a trucking company, honestly. But during their low times, they can be for Saia, it's like close to 15%, 15. But for ODFL, since it has really the market dominance in the highest OR ratio, it can go up to like, I don't know, like 28, 23, 28, around 28 PE. So investors should really focus on the downtimes and invest. For example, the red line I draw there, it should be a good point to enter their position during the downtimes and then wait for the upcoming uptimes. It can take about like 1 or 2 years, but I think it will eventually come, and investors can cash out during the peak, for example 30 to 40 PE, and that's really a plus, because not only has their earning power increased, but also their valuation increased, because investors are again positive on LTL stocks, so they can have this kind of like a double benefit, double whammy kind of thing in their space. So the last part of our presentation comes to the bull and bear thesis. I will introduce both the bull and bear opinion and then leave to you to decide whether you want to invest in the LTL space. So what the bulls are saying is, first, their price disciplines or their pricing power will maintain positive spread despite recessionary economy outlook, and investors should focus on long-term growth, as we mentioned before, instead of the upcoming recessionary risks. And the second point the bull is making is Saia's valuation is at historical bottom. Of course, that is when I make that presentation, it's about like December, last year December, so it is quite low, and now it's pretty high, so I would not say the same thing, but during that time is a valid argument. And so investors should buy the low, and according to past valuation records, yes, and ODFL is a very good comparison or a goal of what Saia can achieve once it has really increased its pricing to match the ODFL and then improve its service, its cost structure, for example. So it really has a lot of potentials ahead, and it is the only, I think, LTL companies that is kind of comparable to ODFL. So naturally, people should turn more attention to Saia and they're like what potentials it can achieve. And I have faith in management according to their past decades of continuous execution that brought the company from a regional LTL company to a national company, and they're doing so well. So I think the management has what it takes to lead the company to become one of the best LTL stocks in the industry. And third is Saia has a pricing opportunity to charge premium for its service. Right now, it's undercharging, so that can really attribute alpha to stock performance in the future. So like we mentioned before, the third point that Bo is making. So Saia is probably close to the fair value line, which means they are relatively like undercharging for their service, but they're really providing premium service. I think they're ranked third in class compared to other LTL providers. So they should really increase their prices in your future, perhaps not by a lot, but like step by step, like what Saia is doing right now. And in the upcoming like 3 to 5 years, we can really see that come into place, and Saia will become a lot more profitable, and it potentially can gather more investor confidence, and they will give it a higher valuation comparable to that of ODFL. So for the bears thesis, the main argument they have is due to decelerating shipping tonnage and volume growth that we're seeing in the past few months. They're saying there could be a greater than expected downturn in the trucking industry, and customer facing inflationary pressure will force LTL companies to reduce their price increases, or even like ask for a price decrease. So that will hurt their margins and really end their streak of positive spread due to GRI increase over the last decade. So that's really significant because the pricing power is what market gives companies like Saia and ODFL so much valuation premiums on. So if that was broken, then everything was have to be reset. But luckily, that was not the case. And right now we're pricing in a more fortunate outlook of a softer landing and more like a softer Fed response. So although I think we're not like completely out of the hole yet, but we're definitely, from what I'm seeing in the volume and tonnage data, whereas I can confidently say that it is not as good as people expect in the last 12 months or December. Right now we're seeing the trend is decelerating and is slowing down. It starts to flatten, and then I think is preparing for another upcycle. in the trucking cycle. So yeah, so I think the market has already priced in this what I already said, and for example, ODFL has increased past its height. So Saya has recovered, I think, 40% since the January. So yeah, so that's very positive news. But their valuation is getting quite expensive. So I would really like think twice before I just rush in to buy LTL stocks. But you know, back in the time when I made that presentation, which is like December, it was a value thesis, and everyone thought it was going to be worse. So yes, so you really have to have some like confidence in the LTL industry or in American economy to be able to make the right call during the right time of a recession. So here comes the conclusion. For the earning per share target, I'm saying $20 per share. Right now it's like $13 to $14 a share. So it's about 50% increase for the duration of 2 to 3 years. So that averages out to be like $400 to $500 price per share. And right now the current price is 286, and I made a brief calculation. So if the price were to hit my price target, it would contribute 15 to 21% yearly returns. But of course, we can't just expect everything to work out perfectly well. For some of the risks is first the policy change of the Fed and the potential change in economy outlook. Maybe we're not having a soft landing again, so that could largely like change the valuations on all the industries, including LTL. And second is the management strategy. So if they can't deliver the price returns that we talked about before, then that is a bad news, right? So that can largely change our valuation model for Saya. So yes, so that are two potential risks affecting the LTL space. But again, I think I remain confident on how Saya can really deliver. Looking at his past records, it's always delivered, and I don't see anything that can like change the past record. Yes, so I think LTL is really a great industry to be involved in and to invest in because it's solid growth and how easy it is to really track the performance of the companies, because unlike some of the tech companies, they have various products or new releases, news, and competitors. LTL is relatively easy to track because it's not that complex. It's track a couple industry data and then focus on the fundamental growth values. For example, the service center expansion that we talked about and the trucking improvements that we talked about. So really, these factors can contribute to long-term growth, and investors should sleep easy knowing that their company are generating such risk-free or less risk returns on their assets. So I think it will be a great choice for example, like sovereign wealth fund or retirement fund to allocate priority assets to the LTL space. So yeah, that's the end of our presentation. I hope you like it. I hope you learn more about truckload and LTL market. If you have any more questions, you can comment below and I'll try to respond. Yeah, so thank you for listening and we'll see you next time.